In the next few minutes, I'm going to share with you about a few ETF concept. You know, how do you actually choose ETF and where to find them and where do you actually apply them in your saving. So I guess I will just briefly talk about what is actually a ETF. ETF is basically a basket of stocks, all right, put together, and it's managed by a professional fund manager, all right. So that's basically what's ETF about, a basket of stocks put together, managed by a professional fund manager. The only difference between a ETF and a unit trust, which also equally a basket of stocks that managed by professional fund manager, the difference between the two is that ETF followed mainly on index. All right, they basically go up there and follow an index fund. Whereas unit trust is basically a objective driven or team driven for that matters. And of course, the major difference between the two is that ETF, the price is very transparent. So it's like you open up a platform, you see the buy and sell price instantly. Whereas whereas for unit trust, the price is always opaque. Now, remember the first time when you go up there and buy a unit trust, you know, through your banks, through your agent, and you decided to buy a fund, you can never get the price until 2 or 3 days later when they will come back to you and say, hey, Mr. So-and-so, Miss So-and-so, this is a price that you got it for this particular fund. And likewise, when you sell them as well, you will never be able to sell at the price that you want. It will only, the price will only comes in 2 or 3 days later. That is basically the major difference between the two. So basically, this is a major difference between the ETF and unit trust. So people will be asking, say, why do I want to invest in ETF? Now, personally, I use ETF as a passive investment. So in other words, when obviously I have different portfolio, stocks and things like that, but there are certain index that I really do not want to spend too much time researching on companies, researching on stocks. I just go up there and buy a basket of company, an ETF. So I just basically buy on a regular basis, just like what Emin has talked about it earlier. Every month, I just buy a particular fund and I just accumulate accordingly. And that basically helps me to build my wealth. And I will use it as a regular saving plan, in short, RSP. So instead of picking the best company to invest, what this diagram in front of you showing is that we just basically buy the whole entire basket of stocks, right? So you don't have to really go up there and pick the companies, and you just basically buy the whole entire index. Now, I will just basically give you an example of what I'm trying to mean over here. Now, this is STI component stocks. So the STI that you see every day, the Straits Times Index that you see every day, 2,800 points, 209,000 points, they all comprises by 30 stocks in the stock market. So in SGX, there are about 762 stocks, 62 companies, but only 30 companies make up of the STI components. Now, the three diagrams that I show on the screen, you can see that the DBS, the four banks actually the three banks actually take up a big portion, and the fourth largest is actually Singtel, and then followed by other companies as well. Now, from this glance itself, you will see that why every time that the three banks go up or go down, it will directly impact the index is because they carry a very heavy weightage about 45% of those weightage goes to that components. And then the rest of it is basically comprises of more on the property stocks. We have 4 REITs in the STI components, and we have a couple of property companies in it. So STI stocks components are basically more on the finance, which is the bank, and more on the property. And these are the 2 main drivers for STI itself. So now, if you want to pick one of the 30 companies to invest as a blue chip, you can. I mean, if you do enough research, you follow the price, you follow the corporate actions and that sort of things, you can actually go up there and invest, for example, REITs, particular REITs that you want, or the banks, or ST Engineering, that sort of things. But then again, let's say if you want to start off and you say, my goodness, there are so many things to do, and you want to be passively invest, on a regular basis. Every month, you just want to buy the index a little by itself, then STI is the way to go. You just go up there and buy the index. So in Singapore, what is listed in the stock market, there are 2 ETF that follows the STI index. One is the SPDR, STI ETF. The code name is ES3. And the other one is Nikko AM STI ETF is G3B. So both are approximately the same. And they have 30 companies in the stocks. Sorry, there are 30 companies in a basket, professional managed fund, passive investing. And the best thing is that it is low cost, right? It is really, really inexpensive compared to you invest in a company. And of course, buying into STI, you are actually investing in Singapore economy, in Singapore dollars term. Now, I got to stress about Singapore dollars is because, as probably you're aware, Sing dollars is actually one of the strongest currency around the region. And in fact, against the US dollars, Sing dollars is pretty strong as well. So when you go up there and buy stocks of companies or ETF or unit trust, if you can, always choose to have in Singapore dollars nominations, all right? So this STI ETF itself will give dividend, right? Because these are all blue chips company, and they do have dividends. Of course, last year was a very exceptional years. But if we go back to the past 10 years records, STI ETF actually give dividends in between 2.9 to 3.4%, which is not bad, compared to your regular fixed deposit. And it is relatively low risk as well. I mean, given the fact that, we look past what happened in March last year, you think about it, STI is continuing to climb back accordingly. Now, of course, I know that a lot of you all will say, hey, STI is underperformed against the regional index, so on and so forth. But let's skip that topic separately. The whole idea is to look at different ETF and decide what ETF can actually help us to invest in the economy or specific themes that we want to invest, all right? So there are basically, in general, 4 types of ETF, right? One is we call the equity ETF, like the one that I mentioned earlier on. The STI ETF is actually one of those. The next group is the REITs ETF. So what I'm saying is that you have a basket of REITs, put together, form an ETF, and managed by a professional fund manager. Then there are bonds ETF, whereby all the company debts are put together into one basket, packaged, and sell as an ETF. And then finally is the commodities ETF. That's where your silver, your lithium, your gold, these are basically the commodities ETF. And of course, in a global perspective, right now, obviously, if you want to hedge against the US dollars, then the the gold ETF is the way that what people would like to invest as well. All right. So not all ETF are made equals. There are two types of ETF is in general. One is known as the physical ETF, and the other one is synthetic ETF. All right, to make things very simple, physical ETF is also known as a cash base. When you buy that ETF, like what I said earlier on, you are buying a basket of stocks, right? And when you buy a physical ETF, you are owning part of the asset, the underlying asset. You actually own them, right? So that's basically a physical based ETF. On the other hand, synthetic ETF is known as a replica of the index. So in other words, when you buy a synthetic ETF, you don't actually own the underlying asset. You don't, all right? You don't own it. And this sort of ETF can have a lot of mechanism inside it for different purpose. So for most of us who are looking into regular saving plan, and most of us will basically want to go with the physical based ETF, unless for, as I say, specific reasons, then you go for synthetic ETF. So that's the difference between the two. Okay. Now, so in the SGX website, SGX website actually has a very full, comprehensive informations in terms of ETF. So these are a list of cash-based ETF over here, as you can see. Now it has a bond index, it has a Euro index, it has a China index, it has a Brazil index, it has again China index, Europe, Japan, Korea, Malaysia, and all these countries. So what does all these ETF do? Now, when you are thinking of investing in, let's say right now, like what Emin say, hey, China economy is booming, because they are, the COVID is well controlled. People are able to get back into their productivities and the economy is growing. And you feel that this is a good time to invest in China while the Europeans or the US is down, then you can actually look into China ETF and buy into their economy. Likewise, if you see that Japan will be coming up from the COVID after the downturn, you can actually invest in the Japan ETF as well. So ETF actually gives you the opportunity to look into other geographic region other than what you are familiar with, that these are the opportunities that are given to you. Now, again, with the one that I showed you earlier on is the cash base, and the other one is obviously the synthetic. Now, the synthetic one, as you can see, that they will have a word called swapped, right? So these are all the synthetic one. Again, with the synthetic, you can invest into very in a different economy as well, like Vietnam, Japan, Bangladesh, Pakistan, Russia, and things like that. So these are being very clearly provided on the SGX website, and you can go up there and read about it. And I'm going to show you later on how to actually access the from the SGX website. Now, what are the reasons for investing in ETF on SGX, right? Or be it in other market as well? Is that number one, it actually gives you a diversifications, right? So let's say, for example, you want to, you form a portfolio and you just only want to have 50% of the portfolio in Singapore, and maybe 30% in US and 20% in China. So ETF will immediately give you the opportunity to diversify, into different economies. So that's number one. Or the other way around to look at it is that you want to look into different asset class. Let's say, you want to invest 50% in the stock market, 30% in bonds, and then 20% in, let's say, commodities. You can have that combinations as well to form your portfolio. So ETF actually give you this sort of flexibility, to meet your the goal that you have, that you want. The second reason is cost effective. Why? Now, like what I mentioned earlier on, if you go up there and buy one stock, one transactions, that is basically one cost. But let's say if you go up there and buy STI ETF, you're buying into 30 company with one price, right? So that is a very, very low cost kind of getting into the market in the general market point of view. Second thing is that typically ETF fund manager charge almost 50% less than unit trust fund manager, 50%. And that 50% is actually quite a huge number, right? So going with ETF in terms of cost is definitely lower than unit trust. Third one is accessibility, like the one that I mentioned earlier on. You can invest into other market rather than Singapore, China, US, India, Taiwan. All this, you can look into geographic region by using ETF. Fourth, transparency. Now, ETF is just like the ETF quote, it's just like any stocks that you will see on your platform. The buy and sell is instant. So if you look at the stock price, the ETF price, let's say if it is $1, and you look at it, you click, you buy, you're buying at $1, right? If you want to sell, you see that it is flashing at 120, you want to sell at 120, you click sell, it's at 120. So it is very transparent. There is no hidden cost during this whole entire process. Right? And of course, flexibility, buy and sell whenever you want. As long as the market is open, you want to square your positions, then you can always use this. You can square these positions anytime that you want for that purpose. So regular saving plan in ETF, and that's basically what I do personally. So I have an account with DBS Invest Saver, and under the Invest Saver, I just opened a so-called investment account with DBS, and there's a list of ETF for me to pick. And one of the things that I pick is the STI ETF, and I put $1,000 into that ETF every month, $1,000 flat. So in other words, when STI was go all the way down in March, I buy more units, right? Because I allocate $1,000. They will just go up there and buy as many units with that $1,000. Now, when STI comes out, like today, 2,800 points, whatever, I'm supposed to buy less unit because, again, I only allocate 1,000. So they will basically just buy more when the price is low and buy less when the price is high. And with that $1,000, it just went on and accumulate. So that's basically known as RSP plans. So I'm using DBS. Other three service provider would be Poems from Phillip Capital, OCBC Bank with the blue chip investment plan, and of course the other one is my favorite as well, is FSM1. They do provide the RSP plan, for you to pick it up, and all these are autopilot. So meaning to say that once you decided which ETF you want to invest, you set the amount. And you allocate your amount, right? For example, you can have set the amount $1,000 aside, and you say, okay, with this $1,000, I want to buy $500 on Singapore market and $500 on US market, and they will just basically go up there and buy the number of units accordingly based on your instructions. So this is regular saving plan in ETF itself. So I'm going to show you some of the informations that I, how to actually get to all this ETF thingy. Right now today in SGX, there are about 57 ETF listed in SGX with different asset class and different geographic, right? You can go to this link and you can find those informations accordingly. But what more I want to show is how do I get all these informations. Now, let's say if I will go back to, I go to SGX website. Okay. You go to this, we'll go to this historical data. And you go to securities. Okay, I'm hitting securities, all right. Then we have this security data. We scroll the way down. You see this monthly trading summary, and that's the ETF. I click download. And I got this file. Hope you all can see that. Let me try to blow it up a little for you guys. I should close this. Okay. So this ETF trading summary, it gives you, and this is the latest issue, latest report in November 2020. And it actually gives you a pretty good breakdowns on the monthly turnover. All right. So you can see that March, right, when the market was tumble, then the volume actually went up. The volume actually went up because most of them are in RSP, right? So when the price is low, the number of units it will auto purchase, it becomes higher. So you can see that it goes at the highest point. And down here, this is really the interesting part. Year to date, 2020 in October, equity, ETF equities has the highest turnover. Commodities has the second, and fixed income, which is basically the bonds, actually has the third one. And we can actually scroll further down. You can see that these two are most popular. All right, SCI ETF and gold. And the reason why people want to buy gold is obviously they want to hedge against inflations, right? So these are some of the references that you can do before you invest in ETF as well, right? So this is what we are doing now. This is what I showed you all earlier on. The other one, yeah, this is what I showed you now. So a typical portfolio using ETF, how do I form it? Now, this is what I will call a income portfolio, meaning to say that I am not expecting too much of a growth, but I'm expecting approximately about 4% return per year as dividend. In other words, every month, every year, I'm expecting about 4% based on the amount that I invested. So that portfolio can be a 50% on SCI ETF, 30% on REITs ETF. There are two to choose from. I will put 10% on gold and 10% on bonds. So this will form a very beautiful income portfolio that will be giving me approximately about 4% per year. It depends on which year. And that basically will go on continuously for, as long as you continue to invest in the market. RSP program, and is definitely better than trying to beat the market or doing some crazy stuff, especially if one does not have the time. I assume that most of y'all have a day job and many things to take care. Seriously, when you do not have the time to monitor the market, ETF, forming a ETF portfolio like this, it takes away a lot of your, unnecessary kind of time to look at the market itself, and everything by doing this is just autopilot. So this is actually one of those income portfolio. Now we can actually, so we may wonder, how do I actually pick this, this ETF? SGX website is pretty good. They actually put in what we call a screener for you all to screen the current markets. So I'll just go back to SGX again. We go to security and we go to screener, and you see the word ETF screener, right? So you will land me to this page, and I can pick the type of either by geographic or by asset class. So as asset class means that I can either pick equity, I can either pick commodities, or I can pick bonds. And geographic, I can actually pick different country. So let's say I only interested in Singapore. So I just click submit, and it will give me a list of Singapore concentrated, Singapore focused ETF. And I start to look from my year-to-date return. That's one of the thing I can sort it out. No, I can't sort this out. I can sort the dividend yield, sorry. See, I can sort the dividend yield, and you can see that Nikko AM STI ETF, wow, 4.2%, not bad. So you can actually sort from the best to the worst based on the ETF that you want, right? So that's Singapore. So again, if you want to go up there and pick, let's say, let's say we want to do Asia Pac, right? Asia Pac. So what do we want from Asia Pac? Do a submit, and okay, this is PSP. It gives you a dividend of 3.57. So in Asia Pac, meaning to say that this ETF will concentrate on not just Singapore, but rather the whole entire region, the Asia Pac as well. So these are the screener that you can use to pick the type of ETF, and you can form your own portfolio by having all these informations that key into it, right? Now, going back to my presentations, this is what I do, screeners, and so on and so forth. Right. Now, okay, this is what I do, correct. So as I said, ETF is part of my wealth accumulation systems, like what Emin has introduced at the beginning of this seminar. And ETF has actually helped me quite a lot, taking away a lot of my, what we call, my worries, I just let it run automatically. So let's say, supposing I do only $1,000 a month, all right, $1,000 a month. That means I'm talking about $12,000 per year. With just a 4% growth, I will be able to achieve about $700,000 30 years later. So I think this is a very remarkable growth, in my opinion, because technically speaking, I don't have to do anything, right? Now, if you find that this kind of portfolio that you need to be adjust, you can always adjust and rebalance, according to what you want to make sure that every time it will calibrate to 4% or even more, and which means that you can even achieve your investment or rather your final goal earlier than expected. So that is the flexibility that you can have on an ETF portfolio compared to unit trust or even trying to stock pick a company, all right? If you're not good. I'm not saying stock pick is not good. I personally stock pick as well. But I'm just saying that if you do not want to spend too much time, too much hassle, taking unnecessary risks, ETF is actually one of those good tools, to consider. So with that, I finished my presentations. I'll be